What's up, Bat fam? Hope you guys had a great weekend. In this video, I'm going to teach you guys how to trade gold using top-down analysis and all the other concepts that I've been teaching, as well as show you guys some trade examples from last week during FOMC. Without further ado, let's get started.
All I do is daydream. They been sleeping on us. I'm just trying to see what
All right, right now we are on TradingView, and first things first, you're going to go to XAU USD, type that in the symbol search. I'm using the Owanda chart, but you can use the FOREX.com, and those are the only two I recommend. So let's start with the weekly time frame. So first things first, if you are unfamiliar with trading gold, gold is more volatile. Gold has a lot more liquidity and volume, and it moves very quickly. And it's a little more difficult to trade than foreign exchange pairs. So first things first, you need to understand top-down analysis or multi-time frame analysis, starting with the higher time frame and moving down to your lower time frame, okay? Not too complicated, but if you need help with that or need a stronger understanding of that, I have a introduction to trading playlist right here, and it has everything you need to know to get started. So first we got to understand, how does gold move? How much does it move for? What's a pip? How do you even figure out how much gold is moving for? How many pips is it moving for? And here's how we can know. Type this up. So the current price of gold is $1,753.28.5. So 1753.23. It's moving right now. The market is open. So as you can see, the number is moving up and down. But currently it's 1753.430. So I'm going to type in 1753.495. Okay, that's the current price. 495. So if gold moves from 1753.495 down to 1753.395, okay, that's one pip. That's one tick, okay, equals one pip, okay, just simple math, all right. A 10-cent movement in gold, so if it went up from 395 to 495 is one pip, okay, so if you had a one lot on that, one pip is equals to $10. $10 a pip, okay, so if you had a one lot, you'd be up $10, up one pip, okay. So now, moving on. If gold went from 1753, same numbers, 495, and it went up to 1754.95, that is equal to, that's a dollar movement. You can see 1753.495 to 1754.495. Same exact last numbers, just a dollar change, okay? That's equals to 10 pips, a 10 pip movement. If gold moves $1 in price, it's 10 pips, okay? So if you had a one lot on that, that would be $100, because $10 a pip, 10 pips, $100, okay? Now, one more example, because this is just pretty basic. 1753.495, same starting number. Same starting number, 1753.495. And we go down to 1750.495. Went down $3. Our last example, we went up $1. Our first example, we went up 10 cents. In this example, we're going down $3, okay? It's equal to 30 pips. Because remember, a dollar movement is 10 pips. A 10-cent movement is 1 pip. So that would mean if it moved $3, it would be 30 pips, okay? Now that's as simple as it gets. On one lot, that would be equal to $300. 30 pips, $10 a pip, 10 pips is 100, 30 pips is 300, okay? Now that you know this is as simple as it is. Don't complicate it. This is all it is. All right, you can take a picture of that if you want real quick. But a dollar movement is 10 pips. A 10-cent movement is 1 pip. Okay? If it moved $3, be 30 pips. If gold moved a 10 bucks from 1750 to 1760, that'd be 100 pips. Okay, $10 movement is 100 pips. All right, now we're moving on. I'm gonna delete this real quick. So we're going to start on the weekly time frame here. You're going to look at market structure and the price action, okay? But as you know, trading is much more than just reading structure and price action. There's a lot more that goes into it, like our pesky emotions and risk management and trade management, all that stuff. So first things first, you have to understand certain areas, certain things here. So you can start on the weekly time frame. We can see that we had a strong bullish move and then a bearish move. And last week, that's some type of doji here. Okay, so now you're going to label your weekly highs and lows. That's where you should start. So first, I'm going to draw a zone right here. And this will be a little more clear on the lower time frame. We're going to refine it some. But this is our previous week's high and our previous week's low. Okay, that's what you want to focus on. You don't need to be looking at all these other crazy levels that are really far away, although they are here, like, right at 1700. There's something there. There's something right here where we respected last week. Where our weekly low is. There's something up here. All these different things, all these different support and resistance levels, it's important to know where they're at, but they aren't necessary right now. But as you can see, I use them, I mark them up, and I've have in my other videos too if you've been watching. So I definitely still use them. But we're looking at different things when you're trying to day trade and looking at certain areas, certain prices, certain things that price did the week before or day before or a couple weeks before. Those are all important. But right now we're looking at last week. Now you can do this on your own charts. You can do this on any pair. Okay, doing this helps you understand which way the market is going to go. This is top-down analysis. So we just started the weekly time frame. We labeled our previous week's high or previous week's low. Okay, so I dropped down to the daily time frame. Right in this rectangle in this zone, an area of supply you can call it. It's going to be our previous week's high. Now you don't have to label it like I am, but you definitely can, as your charts will be more detailed and you can know what technicals are what. And down here for this area of demand, this rectangle down here, previous week low, okay? As you can see, we have an area of support right here. This is a higher low point, and you can see, you can even drag it over to previous price action. This resistance had a break to push higher, and then it came down and tested as support last week, which is our previous week's low. It's a pretty important level. So now we have this marked up. See that the market's currently moving right now, okay? We're on the 12-hour time frame. Here's our highs and lows. Now, as you see, this isn't enough data just to take a trade, right? There's so much more we have to figure out. Which way is the market moving? So we did our top-down analysis. We know where our previous week's high and low is. We can see we're in a strange area because we can't clearly see which way it's going because it's not clearly pushing up and it's not clearly pushing down. It's trying to decide where it's going to go. So this is why it's important to label your previous week's high and your previous week's low. So when looking at this, understanding market structure, understanding how bullish market structure is higher highs and higher lows, bearish market structure is lower highs and lower lows, okay? So what price would need to do, these weekly high and weekly lows are very important because this helps you determine which way the market's going to go, okay? There are certain situations that you can start to map out. There's a few more things we have to do than that. Okay, so we've already identified our previous week's high and our previous week's low. We need to go down to a lower time frame to get some more details. So we can see we were bearish. Right here, we kind of transitioned and pushed up, made a high, and respected this previous area of supply, which is our high point right here. This is where we begin to refine and look for certain areas on the intraday time frame, which is the 4-hour time frame. Okay, so we begin to see certain areas, certain clues that are important. So we can see that the market started pushing bearish after it broke this lower time frame structure, this intraday structure right here at 1772, 1770 price range. Okay, this little area where I have the blue line. And I'm going to draw a little zone so you can see it. Right here is important. Okay, this area is important too at 1785, where these support and resistance levels, these black lines, and these zones are what you need to pay attention to. When price is not at these certain areas and not respecting any technicals, you don't need to be looking at the market or trying to trade. Okay. So now that we have this important area marked up, we have these important areas marked up. Now let's try to determine what's going to happen next. So we know that the market makes lower highs and lower lows in a downtrend, and higher highs and higher lows in an uptrend. Currently, we made a lower high, it looks like. We made what appears to be a higher low point off of this little support, but this high isn't that strong. We rejected from this area. It made a lower high, like it's trying to transition. No, I'm sorry. Like it's trying to push bearish still, like it's trying to go down to test the previous week's low. Okay? That's what it looks like it's trying to do right now. Keep in mind though, if price respects this area and makes a higher low and pushes up to the previous week's high and breaks above it, that's a new higher high point, okay? Which would be our next point of interest. Now, all you're really doing is mapping out these point of interests on the higher time frame first. Then you're going to the intraday time frame, which we're at now, the 4-hour, finding areas where price could potentially react from that are nearby. So right now I drew this level of support. We can see price reacted from here last week, and right now we have this bearish candle that's open, trying to determine which way price is going to go, right? Trying to give us confirmation for the trend direction currently. You need to map out certain areas because price comes to these point of interest over and over. And you could take these short-term trades, these scalps, whatever it is that you're looking to do. But you need to have these areas marked up in advance so that you know where the potential move is going to come from, and know where to take profit, and so on and so forth. So I know it sounds like I'm rambling a bit, but let's go into some of these trade examples before this video gets too long. All right, so you started with top-down analysis. If that's new to you, go ahead and practice it some. But that's all you're doing, starting the higher time frame, labeling your weekly highs, previous week's high, previous week's low, and trying to determine which way the market is moving based off the higher time frame, based off the higher time frame trend. But currently we're just looking at the price action, right? We dropped down to our lower time frame in the daily in 12 hours, slightly lower, not actual lower time frame. We went to a lower time frame to determine what structure is doing and how the market is moving currently. We're getting more details, so that's why we have to go down to a lower time frame. Okay, so next, let's look at this trading example here. Last week, now this trade setup is based off the same exact things I've been saying. This is a breakout trade setup, and this happened before FOMC, and then there's a pullback, and then there was an additional move that you could have caught for FOMC as well. So here it is right here. Here, I'm gonna use this ellipse tool on the price action that we're talking about. So we're looking right here at these candles. All right. And then we're also going to be looking at these candles over here too. Basically the same exact thing. Okay. This whole area. These candles, this whole entire area, we'll be looking at this, okay? So here's trade one that I took. So we can see that there's a few things here. One, I had bought right here at okay, here it is. So I had bought right here in anticipation of a breakout trade originally, like it did right here on this candle. I have this risk to reward tool. And I had some drawdown, and then I also was helping someone pass their challenge on this trade too. And another entry is placed there right at the low because I had some drawdown and I realized that this trade setup was still valid and I took another entry. I had a low risk entry here and I did that in anticipation of having drawdown and managing my risk so that I didn't have too much drawdown before the trade actually happened. And if it didn't work, then I wouldn't have lost that much as it is. I had my stop loss set based off these lows. I believe I had it set at 34, right? 1734. We're going to go to a lower time frame here, 5 minute. I had it set there because I really didn't believe price would come back down to this major point at 1734. This is where price just pushed from, and we were moving very bullish at the time. Not only that, I saw price break above this lower time frame area of resistance here, and this to me indicated that price was ready to go bullish once we broke above. I'm going to remove this ellipse tool. As you can see, we're going to be looking at this price action here, okay? So now how did I catch this trade and what triggered this move? How could you have caught this move just like this? What did I see? So first, although this was an early entry here, it was still a breakout trade, right? When it broke above this level, price shot up to 1747. Now, we can see that once price respected the first time it came down, you can see these rejection candles. These candles right here are very important and tell you that something is different. Something's about to change. This is not bearish. Bearish price action does not look like this. Okay, something was about to happen here. If you go on the 15-minute, you can see this clearly as well. That's a doji candle. That's a very low volume bearish candle. It shouldn't look like that if it's going to push up higher. The previous 30-minute candle closed as such with indecision, low volume as well. This trapped a lot of sellers, but ultimately it shot up. So going back to a lower time frame here, as you can see, once it broke 1740, it just shot up to 1747. This was a 70 pip move. Very quick move. For 112 pips total, but from where my entry point was, well, this entry point down here was good. 1737, I believe it was. But that's where I had half. I had half of my risk that I had up here at this entry on. And so, anyways, from there, price shot up for 50 pips from 1740, 1745, and then all the way up to 1747. Okay, now based off what I told you guys earlier, how to calculate pips for gold, that was a $7 movement. That was 70 pips. Okay, so now let's extend this out. After this move happened, after a higher high comes a higher low. Okay, so after the first initial breakout move, the first impulse, every single time or almost every single time, you need to expect a retest. So boom, large impulse move, then there's going to be a correction. Okay, little pullback. People are thinking, oh, this is the reversal. It's going bearish again. No, it's just coming back down to where it originally broke out from, which is this area of resistance that I had a break, coming back down and then going back up to push higher. All right. Now kind of consolidated a bit, but this was FOMC right here. Okay. This was not FOMC. This was New York Open. This was just New York session. Okay. Gold moves with a lot of volume during New York session and London session, and it also moves kind of well during Asia. But primarily New York is the best time to be trading gold. So after this correction, you can see this line chart that I just drew is the same situation over here. As you can see right here, where I'm about to place the zone, these candles right here, there's low volume. It was moving sideways, although it did go up. It was low volume because there was a news event coming up, which was FOMC right at 11 a.m. So traders are waiting for this move to happen, so there's low volume. Okay, otherwise it would have just shot up like it did. But similar situation. We can see that price was driving up, price was still bullish. We had a higher low point form here. We go to a higher time frame with less data. We can see that break above, higher high, higher low, higher high. Okay, and lower time frame, higher lows being formed right here too. You can see multiple rejection candles, higher low, higher low, and then took off. Okay, so as long as price doesn't break its lows, your trade is still valid overall. But I did close early. I called this in the signal group, and I did close for about 20 pips just because it was low volume here before FOMC. And then I also took the FOMC trade as well, which is this movement here. Okay, I had my stop loss just like this. I had entered at 1746 and had a 60 pip stop loss and was targeting 1750. I believe this was just, 1752. Just a 1-to-1 trade, but I knew it was going to go to 1752 because I was targeting this trade for a while. I was seeing this all morning long, and this was actually the trade I had called back here, but I just simply entered again once I had my confirmation. So right at FOMC, we have this move here, right at the 1 minute time frame. We're going to go down to the 3 minute and 1 minute to show you some more details. So I had entered before FOMC, right here. Somewhere right here, and I did have a little bit of drawdown, but not too much. There's nothing insane by any means. And here we are. Yeah, this looks like it. Entered right here, had some drawdown. FOMC, push up, move down, trap the sellers in, and absolutely took off. See price pushed up and then moved all the way up to 1753.4. Okay, but this was the move on FOMC, and understanding how price action moves, higher highs and higher lows. Okay, understanding that there is a level support right here, which is where price reacted from. We have our level structure here, because this is the higher low point that price had to respect and continue to make the higher high point. After that break, there was a retest for the higher low, break, retest, higher low. This is our major low point down here, major point of structure to continue the bullish move. Here is our minor point structure, right at the blue line, these two areas. To continue the bullish trend, we needed to respect these areas, because after a higher high or a higher low, so it's a higher high, then a higher low. Okay, although new highs weren't being formed here, higher lows were being formed, and those lows weren't being broken. As long as they aren't broken, the trend is going to continue, okay? But if they are broken, then there's going to be either a short-term move to the opposite side or overall trend reversal, whatever it is. Okay, but as long as it's making higher lows and you're seeing a bullish move, it's going to continue going up. Okay, so I had the stop loss down here just in case there's a wild, some more wild volatility and there's a bigger wick, bigger move down, try and come down to fake people out, make it look like the structure was broken. If it did break, then I would have been taken out, and that's fine, but I didn't even come close. And then price shot up for a nice 60 pips, I believe. Yeah, $6, $7 movement, 60 to 70 pips. Now, those are just two situations that you could take for gold. There's a lot more setups that you could take and a lot more situations to add to your utility belt, but this is essentially one way I trade gold, and using top-down analysis as well as time frame correlation and reading the price action and market structure to get an overall idea which way price is going to go, and trading during high volume times such as New York. If you are not familiar with trading gold, I would not recommend jumping into it with high lots. I would recommend demoing it first and practicing it, watching the price movements and getting an idea of how price moves with this pair. It's not for beginners, but it is also easy to trade once you understand, and it moves very well. You can't be afraid of a little volatility, especially when it comes to trading. Now, this video has already gone on for quite a bit, but I hope it was very valuable. I would like to add on to this video later on. And if you would like to learn more how to trade gold and as well as see some of these calls and trades that we're catching in the signal group, go ahead and join Bat Signals. Link is in the description of this video. And don't forget to like, subscribe, follow the Instagram channels, and I will see you guys in the next video. Peace.